the Woodstock Fund. And whenever it comes to raising funds and doing things while you're presenting your ideas to the world, we all as entrepreneurs face a lot of issues. Some of them can be very easily extinguished, and some require expertise. For example, funds like Woodstock. So in today's live session, we have our usual Itheum xPand cohort members as well as few alpha builders and a very talented speaker who will be presenting his ideas on how the world of venture capital works. So, Vokkant, welcome in to this amazing session. And, you know, I would want to hear it out. We want to hear it out from you. What is your role as a research analyst at Woodstock and how things work in your field of life?
Yeah, definitely. First of all, thank you for having me. It's, as I was mentioning at the beginning, I've known the Itheum team for a while. We backed them at the very early stages, and it's been a great journey with Mark and Praveen. And yeah, I'm glad that, both of them are, I can also call them like good friends, and, we've been building together. So it's been a great journey. Yeah, and with respect to Woodstock and myself, so Woodstock is one of India's oldest and largest venture capital funds. We started out in 2019, and so crypto native venture capital funds, not just in venture. That would be a bit too much. But yeah, we started out in 2019, and we've like sort of invested all across the Web3 stack. So we've made investments in DeFi, NFT, infrastructure, gaming, all across the board. We've made 80 plus investments. We have two separate funds now, Fund One and Fund Two. Fund One is more for like early stage investments. Fund Two is more for growth stage investments. Our focus in all of those verticals has been more on infrastructure, because that is where we feel the most comfortable, and we feel like a lot of blockchain, like a lot of value accrual happens in that space. So we have been looking out there, but obviously, based on the opportunities that we are provided, if there's some consumer applications or some DeFi applications that we are interested in, we would definitely, invest in those. Our more like prominent sort of investments are obviously Elrond being one of them, Covalent, Biconomy, Morales, and there's quite a few more. On the DeFi side, we have like Paraswap, we've invested in Oracle, like Band Protocol. So yeah, as I mentioned, like all across the board. Yeah, me personally, I joined Woodstock 3 years ago. So I earlier used to be a dev when I was in college, and I was just like working on some internships, and then at one internship they asked me to like write a smart contract in Hyperledger Fabric, I believe, and that was my introduction to blockchain. And then like I sort of got into the space, and then it was impossible to get out. So yeah, I started working with Woodstock when I was in my third year of college, and sort of continued from there. I graduated last year, and now it's been 3 years at Woodstock, which feels like an absolutely insane journey. But yeah, I think that's the like main thing. Once you dive into crypto, it's impossible to get out. And especially, I think being a VC itself is super addicting, because you like get to experience, like you get to see a wider overall picture of what is going on, what the cutting edge of innovation is, and also like the like sort of dive into the granularities of it with your portfolio companies. Obviously, as builders, you have a much better and much deeper idea of like a particular stack or the particular set that you're building on. But having that bird's eye view is also like a lot of fun, and just like seeing and sort of trying to guide and trying to predict where the space will go. So yeah, I think those parts are really enjoying, and yeah, I'm glad to be here.
Super,
So
man.
shall
Glad
we?
yeah, I didn't know that you come from a background of the tech as well. So that was my next question. Before we delve into your presentation, Bokant, like, so what is every day for a research analyst? Like, what's your every day at Woodstock?
Yeah, so I would say the days kind of vary, but on average, I would say like 40% of my day is just research. So it's just like reading about the different things that are happening in the space, new tech that's coming on, new products that are being built out, how they're built, why they're built this way, what kind of design choices were made, and what the general like sort of thought process was in that. So that is the first thing. That's like a major part of it. I would say like 20-30% of it is then like sort of doing due diligence for particular projects. So like we have an entire deal flow pipeline, and I think we look at close to like maybe like 1,400, 1,500 deals every year. Say I look at like say around 300 400 of them. So a lot of my day is just like going through those decks, and say if we like some deals, we just like look at the deck and we're like, okay, this is not for us, we can move on. And then with some we have to like dive much deeper, which I'll get to with the process as well. Like I'll talk about it much more in depth in my presentation. But yeah, so that is like the second part of my day. The third part is more like sort of ad hoc, like because I have a slightly more tech background. Sometimes I'm working on like pulling some data for us, like if we need to like look at blockchain metrics or like on chain metrics and stuff like that. So that is one part of my day. We also run a lot of validator nodes for our portfolio companies. We run validator nodes for Elrond. So I'm responsible for setting those up and maintaining those. So that is also under my purview. So yeah, I would say that is like a majority of what I do in a day.
Very cool, man. Glad to know, and of course, that seems a lot because sometimes in the tech world, we are usually overwhelmed because of the number of developments that happen over time, right? There's something or the other which is always on the rise, right? There's deepen, there's this some other new acronym that has just popped up and people are hyping around it. So I'm sure wouldn't be the easiest of the job to do,
Yeah.
but yeah,
I mean, yeah, you should never look at my bookmarks tab. Like it's insane. Like my reading list just grows longer and longer. It never like gets shorter. But yeah, it's exciting, and I think all of us enjoy it, which is why we do it.
super, man, super cool, Wokan. So yeah, let us know if we can jump over and get started. We're all excited to hear out what you have in store for us and walk through your process. And then, of course, at the end of this session, we will be opening this up for some Q&A from community as well as from the members who have joined us live.
Yeah, sounds great.
Awesome.
Great. So yeah. So since intros are already done, I'll just skip over this slide. But yeah. So I think I was like talking about why being a VC in the blockchain space is really, really exciting for me on a personal level because I enjoy the reading and like all the other aspects, as I mentioned, like the bird's eye view and all those things that come into it. But I think like being a blockchain VC in this like sort of decentralized world that we're living in is also a very, very powerful phenomenon. And the best part of it is that you can like it's actually very normal in blockchain VC to raise like large multi-million dollar rounds solely just like through online meetings, and that gives you a lot of access. And we talk about this in the Woodstock like sort of thesis as well, is that the entire world will sort of converge together, and like all of these different cultures and all these different people come together to build out products for an entire like wide global audience, which I think works really, really well. So yeah, we've made close to like 80 plus investments now in the entire blockchain space. And in 95% of cases, we hadn't even met the founder before we actually invested in them. Obviously, once we invested, we would like, catch up with them at events and stuff like that. So that number is not true anymore. But yeah, pre-investment, I think we've met like close to like maybe 95%, only 5% of our founders. So I think that becomes extremely, extremely important. The other side of it is, as a founder, what should you be looking for in a blockchain VC partner, right? So first of all, I think blockchain VC comes with a lot of like sort of domain expertise, right? Like you need to understand how certain like tokenomics works, or how like you need to market your product to a certain audience. Like it could be like if you're building for DeFi degenerates, then that sort of marketing spin is very different from something that compared to say marketing for like an enterprise startup, right? Because there again you would want to go through more official channels, you would want to go through people who actually know you and already have trust in you, so that that can sort of grow. So I think that aspect of it becomes very, very important. Secondly, the blockchain space is also very sort of nascent in a lot of ways. Like Bitcoin only started out like 14 years ago, right? Which is not that long if you actually really think about it. So again, like there's not a lot of literature, and you need like people to actually walk you through the whole process. And the thing is that because we're so early, the like it's very quick also. Like as I mentioned, I've been in Woodstock for 3 years, but honestly, some days it just feels like I've been here for 10 years now, because so much keeps happening every day. And keeping up with it, because it's our job to keep up with it, a good blockchain VC will help you with those narrative shifts and help you with those transition shifts. And finally, I think if you're building out like a cap table, having global partners for your cap table is extremely, extremely important. So what I mean by that is just like having VCs from all geographies all over. So like in our case, we specialize in on India, right? So what we bring to the table is actually like access to a lot of users. Now the issue with India is that there's not a lot of like highly monetizable users. So what we do is we get access to you to DAUs and MAUs, but we can't like promise you highly monetizable users. Unfortunately, like the Indian audience kind of lacks that. And the second value add which we try to bring to the table the most is access to developers, because India is like the largest English speaking developer market in the world. So we try to like help our portfolio companies hire and get developers on board onto them, so that they can actually like their hiring processes become a little bit more streamlined. They have access to good devs at good rates as well. So yeah, so what I mean by that is basically that global partners are very, very important. So again, this is something that is true for India. But like say if you want to market in China, or because China has like a very large DeFi native audience, but it's very hard to access them because of language barriers, because of entirely different social media that exists there. So if you want to permeate into the Chinese markets, you need say a few partners from there. Similar for something like the US, if you want to access the SF Silicon Valley tech ecosystem, then having a VC from there kind of becomes important, and that also helps you build more enterprise relationships later on. So as I mentioned, if the kind of product that you're building, the kind of users that you're targeting, try to find VCs who actually correspond to that. And generally with VCs also, you'll see that if they have if they have an expertise in a particular domain, they'll also try to help you out on these particular things. Like I mentioned, we're interested in infrastructure, which is why our dev first goal also really aligns with a lot of our portfolio companies. So that is generally what we try to do. The VCs that we have are also very very different from traditional sort of VCs who are who tend to be more established and tend to have years or decades of experience behind them. Because our space is so nascent, we don't have we have very few people who would actually have a decade of experience here. But at the same time, what we've seen is that the age is just a number, right? Vitalik was so young when he came up with the Ethereum white paper, and we have great examples all around us of people who were actually very young and have founded the best of the best companies in Web3, and can be all across the space, like Ethereum, Uniswap is the biggest DEX, and then a fund like Mechanism. So all across the board, it is very very powerful, and we can actually access those audiences. So yeah, next I kind of wanted to talk about where VCs are actually sort of putting in their money. So what's really interesting about these two graphs is, first of all, even despite the sort of onset that we've seen in the bull market, if you look at the actual amount raised, those numbers haven't gone up a lot, which is very different from the cycles that we've had in the past. Like generally, VC funding increases very very quickly as sort of markets go up as well, but there's generally a 2 to 3 month lag there, but clearly it's not visible. Now my theory on this is that basically because January to December is sort of holiday time, and a lot of people aren't actively raising, or a lot of VCs are on break, so which is why this number hasn't come up as much as it should have right now. But I do expect that this number will just sort of go boom in the next 2 to 3 months, because the kind of markets we're in, and the kind of the kind of activity that we're seeing again on the fundraising side, so I think those numbers will pick up. So I think timing market cycles as a founder is really, really important. It doesn't feel like it should be, but unfortunately, VCs are also very narrative driven, and very, when interest rates are low, they obviously prefer to invest as well, much more. They have a lot more access to capital, which lets them invest more. So as a founder, understanding those market cycles is very, very important. If you've been building in the last year and a half in Web3, you know how tough it is to fundraise, but now progressively that gets easier. And for people who were able to raise in the last year and a half, now they can actually get a much higher valuation as well. So just playing that game of increasing your valuation, making sure that you have enough capital for the next bear market, build through the bear market, and then sort of take those gains in the bull market. That is what VCs try to do, and honestly, that is what founders also need to figure out for themselves. You can't just be sort of head first focused on your product, because what we've seen with a lot of good companies, with a lot of promising companies, is that they end up running out of funds, or 3 4 months into the bear market, and then they're not able to raise, or they have to raise at really really bad terms on a really down round, and that obviously is negative optics, and that doesn't work very well for you later. So yeah, timing those market cycles is extremely extremely important, even as a founder. And the second part of it is just generally how narratives kind of play out. So I think as infrastructure is one of the sort of biggest narratives in Web3 right now. So if you'll see that the chunk of infrastructure investing is always pretty high. What's interesting about the trading and brokerage? So sorry, I hope the graph is clearly visible. If it's a little bit small, okay, I'll just explain the fields that I'm talking about. So the yellow part is trading and brokerage. So what's really interesting about trading and brokerage is that they go to all-time highs when the bull market is actually going on, because people see a lot of organic demand for trading, and then all of these different startups pop up, and then in the bear market they don't have volumes, which is why you see periods like this where trading brokerage is at a very low sort of is not being funded as often, and then that number will grow wide again as we sort of approach the bull market again. And again, I expect this yellow bar to also sort of keep increasing. And finally, I want to also talk about the NFT and gaming part in this graph. So NFT and gaming sort of started out as a proper sector in 2021. Like there were some small projects like CryptoKitties and all that have been around since 2017. But like basically because of Axie and everything, the gaming narrative became extremely popular. So once that new narrative kicked in, it like sort of took up like a major chunk of market share. Everyone wanted to invest in it. There was like quite a lot of froth there. But after a point, you will see that like that sort of dies down, and like people come to terms with reality that blockchain games aren't going to change everything, and we still need to like develop other parts of the stack properly. And that is why we like sort of see that sort of compressing again as well. So playing narratives and playing markets are extremely important as a founder as well. That's sort of the idea with that slide. Now, talking about the deal flow process itself, I think I hinted on this at the beginning of the presentation, but I just wanted to talk about what the process looks like, and this can be slightly different for different firms, but in Woodstock's case, this is how it works. So first, you basically like the deal sourcing happens. Now, sourcing can come in at any point. It can be from other VCs that who are investing in this current round. It can be from like say founders that you've met at different events. It can also be projects that you're sort of helping build out. So we also have a few like really sharp and really smart founders in our network who we want to keep working with. And because we're VCs, we also kind of know what is going wrong in the space right now, or what is sort of missing in the space right now. So we try to work with those founders and try to get them on board and try to work with them on these particular ideas. So that is the sourcing stage. Then there is the introductory stage where we just like sort of get to know the project and get to know each other a little bit. So that can be over like one or two like say 30-minute calls where we're just like sort of understanding what your overall vision is, how that sort of like aligns with our thesis, what the general idea is. Then we get to the second stage, which is the DD part of it. Now DD is like the most sort of intense process in the entire like sort of VC cycle, right? DD can be like at Woodstock we have like three levels of DD. So first is like a business due diligence, which can be like around the aspects of the product itself, what kind of market they're serving, and there's like we have a whole evaluation framework called the 60s framework, which I'll actually get to in the next few slides, and I'll try to like run you guys through what actually is important for VCs when you are fundraising. But yeah, just for the overall process itself, so the DD stage is the second part that can be broken down into business, technology, and legal. So generally, after business and technology, we're in the position to give like a hard commit, and legal generally does close out. Like sometimes we run into certain legal issues which cannot be resolved, but those are I would say fairly rare. On the legal side, it's just like making sure all the docs are right, and if you're raising with the correct instrument and all of that works. And sometimes even our lawyers like just help out founders if we really like the project to like set up the entity structures and figure all of that part out. Then you close the investment, which is you like wire your checks over, you sign the term sheets, I mean you sign the final agreements and everything, and then you get to the post engagement part of it. So the post engagement part of it also varies a lot. We try to like as I mentioned, like post engagement for us can look like talking to founders with them about the ideas that they have, what they want to particularly build out, and it can also be like helping them with developers and stuff like that I've already talked about. So again, post engagement is just like sort of engaging, just working with them on like say a monthly basis, or like depending on how much they actually need our help as well and how much we think we can add value over there. And finally after that, like say 3 to 4 years down the line in equities case, and in a tokens case, depending on your vesting and how those terms look like, you can ideally exit as well. Now, yeah. So as I mentioned, the 60 framework is what I wanted to sort of like talk about next. It's the idea with the 60 framework is that we want to basically create a good mechanism to judge portfolio, to judge companies and like figure out if they actually are like if we should be investing in them, and what should the thought process be when we are actually investing in them. So the first part of it is actually like the first T is obviously team. So I think team, especially in early stage investing, teams matter the most. Like teams, first of all, should have like a very relevant background, and they need to understand the market segment that they're building for. So, for example, like with a lot of our DeFi protocols, we tend to invest in people who are actually DeFi degens, right? Because they understand what they're doing and the kind of market that they are building for, because they've been in that space and they've been in the weeds, they've done all of these things, and they know what kind of products will actually entice them. So I think like that part of it becomes really important. Then the second part of it is tenacity and determination. So as I mentioned, like we in crypto we go through periods of oops sorry We go through periods of extremely like long bear markets, and so not losing hope there, not giving up there is an extremely hard part of the process. And there are days when you like when nothing will be right, and you just need to like keep your head down and just keep building. And a lot of founders do tend to miss out on that. Like I feel like we've seen a lot of founders sort of get distracted from their original purpose as well. And yeah, but in this case again, like we that should not be the case, and there should be like some display of tenacity, and it can either come from like past projects that they've worked on, or generally like sort of trying to gauge that through conversations. But yeah, this becomes a really important aspect. Then the third thing was adaptability itself, right? So ensuring that they can actually pivot and make changes when it's required for the product, because sometimes like narratives in crypto change so fast that at times you need to make those adaptations. Because say if you're building on something that no one really cares about anymore, then you won't get users, you won't get any traction for it, which can be really hard and really difficult as a founder. So just like making sure that you have that adaptability as well when you're looking at all these different sectors. The next part is sort of creativity and imagination as well. Like again, as I mentioned, like when you're adapting, you need to be creative and you need to come up with these different thought processes and like outline them and like make sure that you're approaching the market in the right way. So that aspect of it also becomes very important. And the ability to drive narratives. So just making sure that whatever you are building now, you are able to create the right marketing and the right narrative for it. Like I think marketing is something that Web3 as a space sort of struggles with generally, and more so in the case and like more so in the case of like startups that invest in like that work in these particular segments. Because I think founders themselves also tend to be focused quite a lot on like the product itself or the technology, but not as much on marketing. And the thing about marketing also is that it's really tough to hire like a good CMO for your product, and like because they need to be walked through that entire process. So it's very tough. But and I think like founders need to like spend a lot more time on marketing and driving that sort of narrative. And finally, like leadership skills, which I think is sort of the most obvious one, but obviously like it has to be mentioned. So that is what we look for when we see the like base team, and making sure that all of them can come together and all of them can bring different things to the table, but all of these boxes should be checked off in some way or the other. And yeah, especially in like as I was mentioning earlier, in early stage investing, since there's not a lot of trends, or there's not a lot of data that you can actually use to make decisions, then the team aspect of it becomes extremely important, which is also why it's kind of the first team. And just like making sure that uh, they're able to build and grow in the right direction. Then the second part of this is the TAM, or the total addressable market. So the idea with TAM is that you need to provide like a numerical and like an objective sort of window into what the potential of the company actually looks like. So there are generally like sort of two ways to do this. One is a top-down analysis. So we basically like identify what the like what the potential of the overall sort of space is, like saying that blockchain gaming is currently valued at this, the overall growth perspective is this. And then we like sort of dive deeper and deeper into like like we go layer by layer into it and see uh these are the different types of games being played, these are the different like sort of genres. Those genres can also then be like sort of subdivided into AA and AAA type of games, and then you go a level deeper, and then you're like, okay, so these are the kind of studios building there, what could this particular studio's market share be like? So that is how we like sort of like to chart TAM on the top down level. Then the bottom up level is again like when we have a lot more data for the base company itself, then what we do is we like build from the bottom up. So there we have like some revenue and some numbers, and we try to make estimates about how much that can grow, and how much of that market segment can they capture, and then going up and up and up. So say if it's like perpetual exchanges, right? In perpetual exchanges, we've seen a lot of activity that happens there. It tends to just be airdrop farming, and there's a very few examples of perpetual exchanges that actually have been able to like garner a significant market share for a long period of time. Like for example, DYDX is sort of the only ones that have done that. The recent ones that came out, like Avo announced their airdrop yesterday or day before yesterday, and their volumes have not been very good since then. So that unfortunately, like that is a very relevant thing in Web3. But yeah, so the idea is that you figure out these like small bits and pieces and piece them together and try to see what the overall segment looks like. Again, now going into the Texas example, so we know that centralized perpetual exchanges have insane volumes, and they're doing like 99% of the volumes. So the perpetual tech space in itself is very investable because it has a massive like growth potential. And as on-chain infrastructure is improving, the experience of trading on these decentralized perpetual exchanges is getting almost comparable to centralized perpetual exchanges, which is why it makes a lot of sense to keep growing and like keep investing in that segment. But yeah, like you need to figure out your right players then based on all the other segments. And for founders especially, I would say that I think what we hear very often from founders is that like this is $100 billion market. Even if I capture 1% of it, that is good enough for me. Now that in itself is not a very good statement in my opinion, because I think first of all you should be focusing on like short to medium term TAM, because what is really important for you as a founder is not just to be able to get through, like, I mean, sort of achieving that market share in itself is really tough, but also you need to make sure that you're able to raise for your next round and like your subsequent rounds, or launch your token in the right environment to the right people with the right community backing. So like doing long term metrics like 1% of 100 billion is just does not work. What you need to be focused on is, okay, these are the sort of communities I'll be targeting, this will be my TAM, and then from here I can grow it out once I have more money to these people, which is the sort of like successive like next step. So that is why the best advice to founders in this segment, I think, is just like focus on short to medium term TAM. And yeah, don't tell them that we can capture 1% of 100 billion. I think that doesn't really work. Then the next part of this is the core sort of technology itself, right? So I think it's about figuring out why certain technology choices have been made, and are they the right choices. So like there's something, sometimes it can honestly just be as simple as, does this really require a blockchain? Like I think a lot of Web3 products tend to miss that not everything needs to be done on the blockchain, and there are definite there are obvious benefits to doing something on chain. But like if you're anyway running like a centralized server at the end of the day, then doing like 85% of the things on chain in a very expensive manner just does not really make sense. So figuring that out on a use case to use case level. Then the next part of it is, will that stack actually be able to scale based on what you've built? Or do you need to adapt your solution? Do you need to build like a side chain? Do you need to build a roll up? Or do you need to like sort of adapt to that as and when it sort of comes along? So that in itself becomes really important. The other part of it is also that sometimes there are entirely new paradigms in blockchain technology. As I mentioned earlier, it's a very nascent field that we're in. So every day it's not sorry every day it's not hard to come to like every day there's some new innovation happening, and that can lead to like entirely different things. Like I think so intents is sort of like the new narrative, right? And I think intents will be extremely critical for something like bridging. So they make the user experience much quicker, and we've already seen that sort of PMF with a lot of bridging protocols out there. So sometimes if there is a new paradigm, then you need to quickly adapt and need to make sure that this is like, first of all, you need to be sure that this isn't just purely hype driven, and that this new technology actually makes a lot of sense. So you go back to the technology stack question. But if it does, then you need to also adapt to those new paradigms and sort of adapt and move fast to be able to be the first to market in those cases. Then the other question is also like, is an integrated stack itself better than a modular one? Because what a lot of people like, I mean, I don't mean this just in the context of like data availability and all of that, where we like the whole monolithic and modular debate, but this can simply be a question about your backend as well. So backends also themselves can be monolithic, or they can be like built out with a nice like sort of microservices architecture that is extremely scalable and extremely fast. But setting that up takes a lot of time. So you're also like sort of giving up, like there's always a trade-off in every decision, and that is true for like the monolithic versus modular debates in blockchain, or it can be true for the backend as well. So just making sure that you're selecting the right design paradigm for you. And then the last piece of the technology bucket is, will there be any dependencies? So this is for the founder and the VCs to figure out that, if like say for example, if you're like if you're moving to a new chain, but if an Oracle like Chainlink doesn't exist on that new chain, then you're extremely hampered and you can't really move fast because you are conditional on Chainlink. So that sort of becomes a dependency that slows you down. So just figuring out all of those dependencies, making sure that you're not missing something that could potentially that could be necessary for you to actually be able to expand, is just like very important. So that's when the dependencies part of it comes in. And just like, yeah, having that like strong understanding of the tech and of the ecosystem around you is very important. So that's why as a VC I also said that, like 40% of my time is just reading about all these things to make sure that I also understand, and I'm able to like ask the right questions to these founders as well, so that they also like sort of understand what direction I'm thinking in. It can be wrong, it can be right, but like we that's a process that we all have to figure out together. Then the last part, sorry, the fifth part of fifth of I'm not sure this is number 5 or 4, but yeah, the that part of it is tokenomics. So the tokenomics of it also becomes like very important in this. Sorry, I think did I? Oh, yeah, I did skip a slide. Yes. Yeah. So the fourth part of this is traction, and that again becomes extremely important when you're sort of going through these numbers. Active. I mean, like again, these are like sort of metrics that I've stated out that we kind of look at, but like active numbers, engagement metrics, what like if a user is interacting with your protocol once, will they do it again? What revenue looks like, what directions they're trending in, what does the growth look like, and all the different kind of partnerships you have. So all of this together, this is like a very sort of numerical metric, and it's kind of easy to figure it out. But in early stage investing, unfortunately, like there's a lot of times where these metrics don't exist. So this is a T which sometimes can be a little bit tough to evaluate. As I mentioned, so we have two funds, Fund One and Fund Two. Fund Two, since it does more like Series A and later stage investments, that's when the traction metric becomes really important. Like then a lot of our decisions are based on that. So there are certain, like say, revenue percentages, or not revenue, sorry, retention percentages that need to be hit. Or like if you're investing in a game, D180 retention should look something like this. So those numbers then play an extremely important part. So making sure that the traction actually shows that your product has some level of product market fit, and like users are coming in using it again and again. Uh, Also makes up for like a very viable product. So that in itself becomes very important. The next part of this is the tokenomics itself. So yeah, tokenomics again is, I mean, for crypto protocols, it's really important. And the important aspects, and like tokenomics is like like a whole separate talk. Honestly, like I think you can talk about tokenomics for hours, and you can still barely like scratch the surface of what needs to be done there. But yeah, I think the first thing that you need to focus on when you're building out your token is is the value accrual for the token itself. So making sure that tokens aren't just there to like, they just aren't there for show, right? You need to like they need to like capture and distribute like value as well. So making sure that that is happening in a fair and efficient manner, and like it provides value to all the stakeholders in the ecosystem. So users are getting value out of it, developers are getting value out of it, the DAO that's building on top is getting value out of it, and making sure that all of them are equally, not equally, but like correctly compensated for their time and their effort and their energy. The second part of this is distribution strategies, right? So I think distribution can like literally make or break your entire product. So we have a portfolio company called Paraswap, which as a product they've done really well. But at some stage, like I think 2021, they kind of botched the airdrop, and because of that, they weren't able to like get the right distribution channels, and their token has struggled since then. Even though like if you actually look at the numbers, they're doing really well. The other opposite of this is something like Jito, for example. Like if any of you were involved in the Solana ecosystem, you would know about Jito, and they did a massive airdrop. And at one point, Jito, even though it was securing like I think 1/20th or 1/15th of the like value that Lido was, it was still trading at like a 2-3x valuation to Lido, which just does not make any sense. But because the distribution mechanism there was so powerful, that helped them really like work it out and bring it together. So distribution itself of the token becomes really important, and there are like certain limits around like how much minimum distribution you should have. Like for me, I don't feel comfortable when tokens only have like 2 to 3% of the supply out there, because that is very low float. It inflates the FTV, but as more and more tokens come into the market, it tends to like dip the stock price, the token price and stuff like that. So that becomes a little bit tough. And then finally, it's about like governance, how the governance itself of the model, is it like an effective method? Are users being incentivized to actually participate in governance through they can be various mechanisms for those, but just making sure they're actually involved, and making sure that governance actually takes care of protocols correctly. So I think the optimism sort of like RPGF is a good model to look at of how governance should actually work, what kind of decisions they should be making, and how the treasury should actually be used, and how the protocol revenue should actually be used. So that is something I think all of you can look into after this call, and it creates like a really nice cyclic loop of the token itself, and making sure that value is like sort of spread along all of those shareholders really well. Then finally, I think the most obvious one is timing. So timing itself is very hard to gauge, but it can make a lot of sense. Like while you're building it, once it does not get traction, it could, you could realize that all of this was just because of timing. Like, you could have built out a great product, you could have built out all the right things, but if the timing isn't there, it just isn't worth it. And there's like a lot of good examples of this in Web 2 as well, right? Like Oculus, for example, or Google Glasses, for that example. Like, it's just like they were very good AR or VR tech, but they never really took off because, because it was like a little bit too ahead of their time, or ahead of the curve for that particular time. Then the next part of this is also like sort of hitting the sweet spot, right? Like, you need to figure out what previous trends are, try to like sort of also guess what the future trends will be, and try to time your product according to that. So that also becomes extremely important. And the last and most obvious one is, late to the party, which is just after like everything is done, you're still building out your product, you've been slow to scale, and then that also in itself doesn't really work. So yeah, you need to have like a sense of, what the dynamics look like, and what consumers, and what consumers basically at the end of the day really want. So yeah, I think so. Out of, like, what as a VC, when you're looking at projects, what you want from the, like, all of these metrics is like sort of the points that I kind of mentioned earlier, but just to like sort of, reiterate them in a like much more comprehensive manner for you guys as founders, is that, like, the core team and the founders should have a strong background, and they should, like, be able to prove like strong experience when they're bootstrapping their protocol, and have like good numbers for like have a good track record for sure for them in the early stages, so that that helps you get the first like sort of seed check in, and then from there you can keep growing quickly and quickly and quickly. The technology part of it is, like, just thinking about technology from first principles, thinking about why it's necessary, how it's necessary, and what the execution itself would look like on that side, and what your motives on the technology are. Like, that part of it is also very important. So if all of these like sort of questions are answered when we are doing our DD, then we would also feel like a lot more comfortable investing and going ahead with all of this. With respect to the TAM, so again, the model, like the TAM model that I think I sort of like touched upon, is really important, right? So which, like, are you using the above bottom up approach, or the like the other approach, and what that looks like, what kind of numbers are you actually getting out of it, and are you able to test it out on those users itself. For the traction element of it, so the again, the benchmarks I've sort of already mentioned, but also looking at comparables to your own protocol, seeing what kind of numbers they have, but also then developing like a very strong understanding of why those numbers will be achievable for you. Like, because if there is a parallel to you who's already first in the market, and in Web3 being like the first to the market is a very big advantage. Like, we see that with Uniswap, we see that with so many protocols. So making sure that, you have a clear and concrete plan to actually getting ahead of them is really important. That can be like, that can honestly just also be a narrative thing, but it genuinely like needs to be there very strongly. And then finally, just like modeling what those numbers look like later, having healthy, but having some sort of healthy revenue predictions. Like, I've also seen like a lot of revenue models that just like do not make any sense, and they like somehow like assume that, their growth will like 20 or 30x every year, which is beyond me. Like, when you can't be making like say $5,000 as a protocol and like claim that you'll get to 1 million at the end of the year, like that just does not make sense. And trust me, a lot of those models do exist in Web3, unfortunately. So timing wise, I think the macro part of it was very clear from the first part, from my second slide, I think, where I talked about, what narratives look like, and understanding the market cycles themselves, and then finding PMF for those particular products in the right time frame. So again, being like, like hitting the sweet spot, and just not being late or ahead, and just like figuring out exactly when you need to get there. And again, the market of, like timing the market cycles itself again is sort of extremely important. On the token aspects element of it, I think I've sort of like touched upon all three of these already. So yeah, I think we can just skip those. So yeah, so when you're actually reaching out to when you're actually reaching out to VCs, what you should be doing is, you should first of all like highlight the 60s, and talk about why all of these differentiations exist. On the pitch deck, be sure to have like, very comprehensive like sort of parallels and differences section in between your competition. Talk about why the token is extremely necessary, and just generally like maintain some hygiene. Like, we tend to see some pitch decks that are extremely cramped, or not well formatted, not well edited. And as a VC, when you're looking at like say, 5 to 6 pitch decks a day, it becomes like those things do matter. Like, unfortunately, I would like to say that, I engage with every pitch deck properly and I spend my time on it. But honestly, sometimes I'm just looking at pitch decks for like 5 minutes, and then I'm just like, okay, yeah, this doesn't make sense. And that's when like all of these hygiene elements sort of play a very important role. So that in itself becomes very important. Then when you get to the introduction stage, so I think there the open culture of Web3 really helps. Like I think in Web3, luckily, with the kind of network we have, we can access a lot of people, and like we can get access to the best funds in the space, or we can get access to the best builders in the space. Like if you've actually like DM'd anyone on Telegram, you will realize that in like a lot of cases they just reply to you. Like I think one of the best learnings I've had in the last year is that like as you build and as you do better things, you can actually like work with your so-called heroes on a lot of on a lot of things. So that open culture in Web3 really helps out a lot. The next part of it, this is just like the elevator pitch, like just doing like that 5 to 10 minute pitch and working out how quick you want, like how do you quickly sort of like lay this out, how do you give them a lay of your land and be able to like sort of uh, uh, like basically market your product really well in that short span of time. The third part of it is customizing it to the VC that you're talking to. So if you're talking to like say an infrastructure driven VC, then giving them points about why your tech, like going in a little bit deeper on the tech side definitely does help a lot. Like if they think that you understand the tech, they will be a little bit more like they will favor you a little bit more compared to like say other investment opportunities and other options. So customize it for the VC that you're actually talking to. Go through their portfolios, make sure that like if you see any sort of like synergies, then like you can immediately point them out. If you already know some of the founders in their portfolio, that also creates a very good reference check. So just like customize that pitch for every VC that you're talking to. And cold calling is also like cold calling somewhat does exist. I personally don't think it has a very high success rate, but for cold calling I think like my only sort of advice there would be, don't send them like a really long message with all the traction and everything in one go. Send them like a brief glimpse of what exists and like format it really well, make it look good, but don't give them all the information. Just give them enough so that they're intrigued and they actually want to set up a call with you. Sometimes what people do is they tend to give out a lot of information, and since like like as a VC you have to get like, if it's a completely like cold call deal that you need to like sort of get reference checks done, you need to take like 2 3 extra steps in the process. So try to make sure that the VC thinks that it's worth their time to go through all of that and actually talk to you. So that is where the cold calling sort of element comes in. On the term sheets and soft side, so I think the first thing is figure out how much capital you actually need for the current stage of growth. Like in general, I would say like having 2 to 3 years of runway in the bank sort of helps. But when you get to like like 8 to 9 months left, that is when things get a bit tricky. Like that's when you start feeling the pressure, and especially if it's a bear market, then fundraising can sometimes take a really long time. So just like choose your capital correctly for the market that you're in, and make sure that you can outlast the bear market. So choosing, just like figuring out how much capital you actually need without diluting yourself too much is extremely important. Then the next part is choosing the right instrument. So if you have a good mechanism for token value accrual, should you go for a soft, or should you still do a safe in the beginning, or should you go for a safe plus a token warrant? Now, unfortunately, as a VC, this answer also varies a lot with the kind of market that we're in. So, like when we're in a bull market, that answer will be tokens. When we're in a bear market, that answer will be equity. In between, that answer will be safe plus tokens. So that again gets a little bit tricky. But I think yeah, so you need to adapt to that a little bit, but also at the same time like understand your business, know exactly where your sort of strength lies, where like where you can make the value flow to. Do you want to, like if you can make value flow to a token, then go with that route. If you think you're more of an enterprise facing business that won't see a lot of value accrual, then you go for the equity route and you stick to it. But just making sure that you lay out those thought processes clearly to the VCs about why you're doing this. Then the next part of this is the term sheet itself. So understand what the term sheet looks like. There's like a lot of different terminology in term sheets as well that matters quite a lot. So like what, like say an anti-ratchet full dilution round looks like. So that is basically when your valuation is lowered, but the previous investors get like say if we've invested like 100K check into a company, but now that 100 at a 30 million valuation, but now they're doing a down round at a 20 mil valuation. So the value of our 100K check actually increases if you guys do a down round. That's what anti-ratchet full dilute and anti-dilution means. Sorry. So yeah, like there's like a lot of terms like that. So just understand what the term sheet is actually talking about. Figure out that exactly what is in there, and like looking at boilerplates for that as well. For SAFT again, like tokens, when like bull markets are high, SAFTs are like when bull markets are upon us, SAFTs are like the best way to actually be able to fundraise. And there's a very famous like sort of Y Combinator template for SAFT, but again like you can like sort of discuss that with your legal team and figure out what the best route is for you to raise. It can be a token warrant as well. Like there's a lot of different like sort of sub options and all of these. So just like, yeah, make sure that you're making a conscious choice about this and not just going with something. You can consult your VCs about it. You can talk to like say 3 or 4 VCs about it. Make sure that you're taking the right route, but just make sure to have an opinion on it because this does matter quite a lot. So yeah, I think that's it for my presentation. Happy to take up any questions, or if there's any follow-ups, let me know.
Yeah, Wokan, firstly, thank you for spending all the energy and helping us, simplify this complex subject, right? But sometimes founders, and startup founders in specific, and in the space where we are in the Web3 space, maybe they don't have a financial background. So all the info that you share is very helpful, and this adds a lot of value. I have a couple of questions that I would want to ask you, but I think I'll open first the expand cohort. Johnny had a question already. Johnny, I noticed, so we can begin with you, and we leave the stage open for others to ask, and there are other some questions from the community as well. But Wokan, thank you for spending your time and helping us, and of course, like things like TAM, SAM, and SOM, right? Like I digged into it, and sometimes it's not easy to understand that the market is inflated. What's the real size of the market? So that's one question that we can cover at the end. But Johnny, if you're ready, I'm just going to overlay your
Hi
question.
there. Yeah.
Yeah.
Yes, thanks for this very dense presentation, Vokkant. Uh, I learned a lot, and I'm still learning, hearing all that. Uh, at the start of the presentation, you were talking very shortly about the legal environment for startups, and this is something I'm kind of keen on because how do you see how do you see that the legal environment can impact the incorporation of startups, the choice of incorporation, and what's your how do you tackle that? Do you advise, or if the startup is already incorporated, do you do some risk assessment on those startups in order to make them grow better?
Yes, so I think that's a very good question. Unfortunately, so I'm not the perfect person to answer that because as I mentioned, so I'm involved in more like the business and the technology due diligence. The legal due diligence is something that happens afterwards. But as you mentioned, right? So at my level, I would say the regulations matter also because of the kind of decisions we're making, right? So let's say there's a product that's focusing on India, crypto product that's focusing on India right now. Now, India is a really bad market for crypto as of now because first of all, there's 1% TDS on every transaction that you make in crypto. And on top of that, you pay 30% in capital gains, or like it's not capital gains actually, it's like a 30% crypto tax. And also, you can't offset that tax with other losses that you make in crypto. So like the current environment is extremely, extremely bad. So if a project was say building for India, then we would have to like, really look into it and make sure that it's a really good project, a really, really strong founder, and all those metrics really match up for us so that they can build in this like tough regulatory environment and make sure that things are flowing smoothly there. With regards to where to incorporate, so I know like, there's like some preferred routes for token entities. Like I think the BVI is one very big one, the British Virgin Islands and the Cayman Islands. Singapore is also like sort of forming up pretty well there. But as to like the benefits of each and every single one, I'm not the right person to talk about because that is not my expertise, unfortunately.
Yeah, thank you. No, but that's clearly some in within Woodstock you have specialists which you drive founders to in case there is some needs. Yeah,
Uh,
we are two founders, one in France and one in India, and both environments are crazy. But okay.
yeah, being a founder in India is not the best right now. It's a little bit tough.
Yeah. Awesome, Vukan. So I think you also mentioned one very important subject. It still strikes a chord. You mentioned that, of course, it's not just the capital that the VC can put in, but also the domain knowledge. And I think at Etheum as well, we feel that's very highly valuable, especially like having people like Woodstock, your fund, being a part, and few others who help us understand and identify these big problems that we see and just break it out in so simple terms. So I think that's where we're heading, right? No matter if it's a bull market or if it's a bear market, irrespective of the market conditions, if you're really solving that problem and having the right support from funds, that makes a lot of value. So yeah, totally on point. Any questions if you have from the expand cohort? Firstly, we can address them now, and if not, we have some community questions as well for Vokkant.
I have a
I
question.
might. Oh, go ahead.
Please feel free.
Yeah, just want to know about the tokenomics law. Uh, did you see, I mean, come up across any project that doesn't have their own tokenomics and they use the base tokens from the network?
Yeah, I mean, there's a few like that do not have their own token at all, because that would be a little bit tough. But like, say there's projects like Arbitrum or Optimism, right? For example, where they actually like on Arbitrum and Optimism, you pay gas fee in Ethereum, but they still have their own tokens for like governance and stuff like that. But it's not the main sort of utility token that exists on their platform. Now, Optimism and Arbitrum both have different use cases, like which tie into their sort of wider ecosystem. And I think with Eigenlayer sort of going live, we'll see a lot of these tokens also come up where they're using like the base level security of Ethereum, so they actually might not need to launch their own token. But I think there's a very few examples of like projects that have just not done their own token and are also not doing equity. Like I think you need to get value in some cases. There can be equity only businesses that are building on top of this. That is, I think, definitely possible. Lots of those. Yeah.
Okay.
Yeah, not everything needs to be tokenized at the end as well, Vokkant, right? So
Exactly.
that's another thing. Most of the projects think that token is like a mandate, but of course, token is not for everything. Ciprian, you have a question. Let's chip in and hear from you.
Yes, I do. Vokkant, first and foremost, congratulations for the great presentation. It's awesome to have such a nice insight to the way VCs interact with the Web3 space, because as you see in the Web3 space, things are being done in a totally different rhythm and pacing than the regular venture capital. My question here, because you mentioned the monthly active users and the EBITDA numbers, and the way a VC is looking at a tech project in respects to like a Web2 market. You also mentioned the importance of being ahead of the curve and not to be late to the party. So when you're getting into a new cycle from a bear market to a bull market, there are projects that start with a very new technology, with an awesome technology, or partnerships, or very good teams, and they're just about to launch, but they don't have yet the MAUs and the EBITDA numbers, obviously. What is the way to consider these projects and to get an investment secured in this without having the regular MAUs and the EBITDA numbers?
Yeah. So I think in a bull market, everyone sort of anticipates that those numbers will be lower. Like I think every VC sort of knows that, okay, if people aren't interacting with this protocol right now, that kind of makes sense, right? I think like Gearbox, for example, is one protocol that I really like. And if you look at Gearbox, they have, again, really strong tech, and they have a really strong product for like DeFi, like fundamental DeFi users. But in a bear market, using Gearbox doesn't make sense, and all their numbers sort of like trend down immediately. But immediately at the onset of a bull market, you do see that those numbers are sort of chopping, like going up again. So there, I think it's about like basically understanding the technology stack that exists and the use case for your own product. And I think like you would never know if you'll be able to market it correctly. Like as a VC, you are sort of taking that risk, but you just make sure that if these two like sort of boxes are checked off, then it would be worth something investing in. And as the bull market sort of like comes back in again, then you'll see like really, really good traction for it as it happens.
Of course. Thank you very much for answering the question. Yeah, this is very important because variant technology gets a lot of traction during the bull market, when there's a lot of attention coming to projects, but the monthly active users and the numbers will start to come gradually, but technology is there, the proposition is there, and yeah, thanks, man, appreciate it.
Awesome. Johnny, you had a question as well, so we can address it now. Feel free.
Yeah, thank you. Vokkant, I read also the research paper you did on Itheum. It was already almost more than 1 year ago. Very interesting. I want to ask if you talk a lot about the data economy in this paper, and it's really interesting. And since 2022, did this data economy change? Are there more projects that are coming up in this? And the most important is the user. Are the users sensible to it yet, or is it still something to come?
Yeah. So I haven't deep dived into when I was working on that research paper, but like what I've been seeing on the periphery is I don't think it's changed that much. Like I think the shady market of data brokers are still like larger than ever. There's still like mass data campaigns all over the world. Like our information is not really private in any way, and users do not really own any of their data. I think there's a few like sort of interesting startups that have popped up in the Web3 space as well. That sort of there's a lot of like data DAOs that have come up. I think Multicoin also recently invested in one. So there, the idea was that you sort of provide them with your trading history. Using your trading history, they'll take certain trades and like they'll do certain not trading history. Sorry, you give them your like social media history, like you export your data on Facebook and Instagram and give it to them, and based on that data, they'll figure out sentiments for the entire like ecosystem, like Web3 and the wider world. Take some trading bets based on that, and then try to grow that money for you. So that I felt was like still like a more interesting product, but at the base level, I unfortunately haven't seen any major changes to that. I think there's a lot of regulation that's coming in, and I think like the EU is making like some of the right steps with like what they're doing with GDPR and stuff like that. But again, like nothing too concrete, and I think it will take some time. And Web3 is the right way to solve it, but unfortunately, I think we have some like bigger problems to deal with right now, and then we can like sort of integrate with this once the user experience is slightly better and get everyone on board, and then try to like solve for it in a lot of ways.
Yeah.
Yeah.
Agreed. Thanks.
Awesome, man. So, of course, Wogan, sometimes I see you like a scientist, right? Like while you're writing these research papers, because it's usually research and it's not medical, but it's financial. So, of course, thanks for like delving deep, and we'll chat more. But you mentioned about social media, and we have a product that Dents represents, Wokan, called Kalilio, and they're also trying to solve this the social media issue, because especially the data on social media, it's a social platform, right? So it's public anyway, but how adverts are targeted using that is another thing. So Dents, if you have a question, feel free to chip in as well. And
That's actually a perfect introduction, because I had a question. So great. Vokkant, first of all, that was brilliant. So thanks very much for your time. I loved it. So my question is, are you guys looking at social fi projects at the moment, decentralized social platform? And if yes, what is it that you're looking for in a social fi project to invest in it?
Yeah, so SocialFi, I definitely think we would be keen to invest in it. Unfortunately, it's not my sector, so I cannot comment on it. Like as I mentioned, I'm more infrastructure focused and gaming focused.
Yeah.
But SocialFi as a sector, like I mean, I definitely see it as very promising. Like right now, like especially with the sort of stuff that Friendtech was able to pull off briefly, and even with like Farcaster and everything that's going on there, it's definitely like a very interesting sort of segment to look at. Yeah, if like if you have a deck or anything like that, I'll be happy to share it with my team, and then they'll be much better to like answer these sort of questions.
Sounds good. Yeah. Perfect. I have another question, which is more general to VC. So, when investing in an early stage project, what is the main component that's going to make you invest in them? So, I know you just presented the 60s that should appear in your pitch deck if you want to succeed in front of VCs. And perhaps that's going to lead to a similar answer. But let's say you've got three projects that stand out as potential investment, and they're all great at the 60s that you presented, but you have to only pick one. So, what's going to weigh in the balance to support your final decision?
Yeah. So actually, this is an exercise that I was sort of doing with myself as well. Like, looking at the investments that I've made for the fund and seeing the kind of returns that they've generated, and, what I've done well, what I've done wrong, and trying to figure that out. And I think for me, on a personal level, I think what I did was I focused on the technology a little bit too much. Like, I think that was something that I'm trying to fix now, because for me, like, again, because I used to be an engineer, because I've like, used to write code for a bit. And like when I read about blockchain, like that is my focus as well. That is what I enjoy the most. So I tend to focus on technology aspects a lot more. And I've ended up like sort of picking some founders who are extremely strong on the technical side, but then they're not able to market their product correctly, or they're not able to sort of put it all together in the right way, shape, or form, even though they're building out great tech. So I think that is something that I have sort of missed out on, is not looking at the whole picture. And I think that is what you should be doing as much as you can. So I used to, I think, over-index on technology, which was incorrect on my part. And I think now that I think I'm trying to fix for it, but I think I would still, like, if those projects are actually all equal in terms of the 60s, then I'd say I'd go for the ones whose technology I like the most.
Right. Yeah. So basically, what you're saying, it's quite down to the profile of the VC that you have in front of you. So it's quite good to know who you're talking to. So it's quite interesting to know. Yeah.
And like, again, different members in different VCs will also have like very different views, so that could also like play
Yeah. Exactly. Yeah. Cool. Thank you.
Awesome, Wokkant. One question from my end, buddy. So we talk about, I hinted this, right? Like, when we talk about the target market, and when you look at TAM, SAM, and SOM, right? Like these three intrinsics together, how do you as a research analyst figure out whether that market numbers are inflated, whether that's real? Because it comes from a source, and that source is of course reliable. You have to be a credible source, but how do you actually figure out whether that's not inflated in any way? Because that depends, that decides a lot of aspects for you as a VC.
Yeah, so I think first of all, I think trying to get verification of that data from like different sources. I think that sort of helps you understand how much, if there is some level of like if there is some miscounting there. Now, if the entire space in itself is sort of in a bubble and is is extremely up there, I think that is very very tough to tell. Also as a VC, like I think we all fall prey to it, which is why like that narrative chart also becomes really important, right? That when narratives are in bubbles, everyone does put money into it. So it's hard to tell when you're in that bubble. I think once you're out of that, it's very easy to like look back and be like, oh yeah, obviously that was a bubble. But yeah, so that I think is like sort of an ongoing process, and you try to learn it. You try to talk to as many different people as you can, try to get as many different perspectives as you can, especially for people like sort of building in that space, and people who actually are like have accurate numbers to what that looks like, or what that particular segment looks like, and what sort of challenges they face. So I think that makes the process easier. But yeah, unfortunately, I don't think there's like 100% accurate way to figure out what is a bubble and what is not.
Yeah, good to know that you mentioned data at the start, right? So that's something, maybe using our data NFTs, there could be some way for the VCs to share the data between them. And that
Yeah,
might be.
I think I've actually discussed this idea with Praveen at some point. I do remember that. I think this was a conversation we had at some point last year.
Yeah. Cool, man. So we still have one more question left. If there's nothing from the cohort, I'll just pin it on our screen. And Kathleen wanted to know, Kathleen, if you're still here, like what's the minimum ticket size that Woodstock is interested in? Do you have like I think it's depending on the industry, but feel free to let us know what you think is
Yeah.
a
So
min-
basically, there's two. So we have two separate funds, Fund One and Fund Two. Fund One is the more early stage one. So there are minimum check sizes around 150 to 100K, and our average there is like 200, 300K, and we've done checks of up to 1 million from Fund One. And on Fund Two side, we have like that's more growth stage companies. So there we've done checks of like 500K, but the average there is 1 million, and we've also written like 5 million checks from Fund Two.
So it's quite variable. Hope
Yes.
that answers your question, Kathleen. If there's no question from the xPand cohort, I would just want to call it a wrap, Wokkant, because it's you've spoken a lot and you've covered a lot of stuff, right? So this huge presentation, we would be love to share it, with the xPand cohort as well later down. And yeah, thanks for taking out your time, man, to interact with all of us. And this is, of course, our first xPand program. A lot more is under the wraps as we progress with time, but data is the key, and blockchain is, of course, the tech that we're all interested on. So thank you, Wokkant.
No, no. Thank you for having me. It was a great pleasure. And if there's any way I can help out any of you, please don't hesitate to reach out.
All right, thank you for
Thank you.
tuning in. Bye bye.
Thank
Thanks
you.
very much, Vokkant. Have a nice day.